Let's move forward now in talking about the different product classes that we offer. We're going to start off by talking about our bank statement programs, and it's important to understand why we offer 4 different bank statement products. Effectively, you have a series of borrowers that are in a different position from a credit profile and background standpoint. The reason we offer a variety of programs and bank statement programs that may seem excessive is to cover the full gamut of the credit borrowers that are available that are looking for financing in the marketplace. To start off, it's important to understand how we've graded our programs. Any programs that are classified with a plus, for example, our 5024 BS plus or our 5012 BS plus, indicate a near prime status. What do we mean by near prime? Meaning we're dealing with a superior borrower with superior credit history, mortgage history, bankruptcy history, and effectively the higher the classification of the borrower from a credit standpoint, the better the pricing. So it's important to understand that the 12-month plus bank statement program and the 24-month plus bank statement program each have higher standards. I'm looking to you to review the details of the programs specifically. My intent here is not to go line by line on the guidelines and give you specific information that's readily available in the guidelines, but to give you a highlight so that you have a better understanding of these products. The plus programs, both 24 months BS and the 12-month bank statement product plus, both require minimum of 680 FICO score. It's important to understand and differentiate these 2 programs. Of course, just like the program description, 12 months bank statement compared to 24 months bank statements to qualify. Both programs and all of our programs allow for use of personal bank statements, business bank statements, and commingled bank statements. Now, what do I mean by that? It's important to understand these different classifications, and it's important to understand how they apply to a specific borrower profile. The use of personal bank statements are based on the fact of a borrower that has separate business bank statements and personal bank statements. The assumption is that all the income goes into the business bank statements, and then they transfer those funds for their personal use to their personal bank statements. As such, the use of personal bank statements requires that the borrower has that separation of personal and business bank statements. We're using the personal bank statements to qualify. However, it's important to understand that we are looking for 3 months business bank statements just to show that the funds are being transferred from the business to the personal. That's a critical requirement of the use of the personal bank statements. The second option for qualification is the use of business bank statements, but the business bank statements alone cannot be used. The business bank statements are used in conjunction with an accountant-prepared profit and loss statement, unaudited, in order to calculate the borrower's income. How do those 2 go together? It's very important to understand this. The 24 months business bank statements, the cumulative total of deposits are equal to the gross income on the profit and loss statement. Then the borrower is to provide all their actual business expenses to their accountant, all their overhead, actual overhead for operating the business, minus any personal funds that they have used or received for their own benefit. For example, many self-employed borrowers may pay their car expenses out of their business. They should not include that in the P&L. They pay their personal health insurance out of the business. That should not be included in the P&L. The idea is to get a total amount of actual business expenses on the P&L so that that can be subtracted from the gross income. And as I said earlier, the gross income is the cumulative total of all the business bank statement deposits of course, minus any transfers. What do I mean by transfers? If funds have gone back and forth from a savings to a business checking account, that's not income. That needs to be excluded from the total deposits. Back to the profit and loss and back to how we calculate income using business bank statements. So at this point, the total deposits from the business bank statement carry over to become the gross income for the profit and loss. The borrower provides all their actual business expenses, and that leaves the net income. What we use is the net income divided by 24 months or 12 months, depending on if they're using the 24-month bank statement or the 12-month bank statement. We are looking for one profit and loss. If a borrower is using our 24-month bank statement program, we're looking for the P&L to match up exactly from a timeline standpoint to the same period of the business bank statements provided. Quite often we get inconsistencies where the 24 months business bank statements are for a different period than the P&L. That's not acceptable. They need to be exactly within the same timeline. In addition to that, we need the P&L to state exactly the starting day and the ending date of the P&L. For example, bank statements used a 24-month period from January of 2015 till December of 2016, representing 24 months, have to be represented on the profit and loss statement as P&L for the period January 1, 2015 through December 31, 2016. Those dates have to be absolute, and the gross income on the P&L has to coincide with the total deposits of business bank statements, of course, minus any internal transfers. That has to match. Again, we then go down to the net income on the profit and loss, and we take the net income on the profit and loss statement, divide by 24, and that's how we calculate the borrower's income using business bank statements. We use business bank statements concurrently with the profit and loss in order to calculate income. It's important to understand how these two go hand in hand. As such, it's important to understand we cannot calculate income strictly on business bank statements. Without that profit and loss, there is no way to know what the net income is. Alternatively, the third option for calculating income on bank statements would be the commingled. In many cases, small business owners may be running their business out of their personal as a commingled bank account. What does that mean? That means that they're basically receiving income in their personal name, in their personal account, paying out personal expenses and paying out business expenses concurrently. We treat commingled personal bank accounts much like business bank statements because we have no idea what the actual business expenses are. As such, a personal bank statement that's commingled, that's used for business, is also used concurrently with a profit and loss statement. It's important to understand how this calculates out on a personal bank statement that's commingled. And what we mean again by commingled is used for personal and business concurrently. You quite often find this in with consultants or home-based businesses where the borrower is actually receiving all their business income in the personal bank statement. They don't have a business bank statement separated, and they use that one personal account to pay for their personal expenses, concurrently paying for business. In that case, we have no idea what their actual net income is, and averaging out the deposits really mean nothing to us. With that, that's the general formula that we're using to calculate income on our bank statement programs. Again, you have three options. You have the personal bank statement where a borrower has a separate personal and a separate business, and they want to use the personal bank statements to qualify. In that case, we're simply taking a 24-month average of deposits. Then we have the business bank statements that need the profit and loss to calculate income, and again, we use the net income off the profit and loss. And then last, the third option is a personal bank statements that's used for business and personal use concurrently for a borrower who doesn't really have business bank statements, who doesn't have a separate business account. That third option is much like a business bank statement account where a profit and loss statement is necessary. As a reminder, we understand the complications of this, and we also understand a lot of borrowers do not know how to relay this structure to their own accountants. We do have a preferred accounting firm that understands the formula of what we're looking for, and we do have a special negotiated rate with them. They are located near our office, and we do introduce the broker and borrower to this accounting firm. Of course, the relationship will have to be directly with the borrower. They need to retain the accounting firm. We do not have any direct contact with the accounting firm, and neither can the broker. The borrower needs to be working directly with the accounting firm and provide the bank statements to them and provide the expenses to them in order to get the profit and loss. We have negotiated this special program through this relationship to be a flat $295 for the profit and loss and the related accounting verifications and ownership letters that are necessary. It's a flat fee, and it's typically much less expensive than their alternatives with their own accountant who don't really understand what we're looking for. So that provides some solutions from income calculation on bank statement programs back to the variety of bank statement programs we offer. As I mentioned earlier, we have our 12-month bank statement plus program. We have our 24-month plus program. Again, these programs require superior borrowers' credit profiles, such as 4 years from a housing event, 4 years from a bankruptcy, and a minimum of 680 FICO score. The alternative programs are our regular 5024 BS. That's our regular 5024-month program, and that requires a minimum of 660 FICO score and allows somewhat a level of flexibility. That's the mid-tier borrower. Last but not least would be our 5024 BS NP program, where you have the most level of flexibility, and we allow borrowers with a minimum of 580 FICO score to obtain bank statement loans, and that's limited to 80 LTV at a max loan amount of $750,000. I urge you to review the matrices directly. Again, my intent on this call is not to go through line item and point this out to you, but it's important for you to have the big picture of what we offer and why we offer the variety. And then it's your job to go into the matrices and understand and study the different tiers and the credit profiles, reserve requirements. Each of these programs have different reserve requirements. For example, it's important to understand that on our plus programs, we have a hard and fast rule that it's a max DTI of 43, while on our regular bank statement and our NP bank statement program, we allow up to 50 DTI. Well, the only catch is that at the 43, you're at 6 months reserves up to $1 million loan amount, but above 43 DTI on our regular bank statement and our NP, the regular meaning 660 minimum and the NP meaning 580 minimum, as soon as you exceed 43 DTI, you suddenly jump to 12 months reserve requirements. It's also important to understand that a lot of folks think that cash out could be used for reserves. That's an exception and requires compensating factors. Compensating factors are typically misunderstood. Like I said earlier about ATR, you have to realize that 50% LTV is not a compensating factor in allowing borrowers cash out on the loan to be treated towards reserves. Now, there are cases where that can be used, and those cases are where a loan is a debt consolidation loan. The borrower is paying off a bunch of debt, bringing their overall expenses down, and benefiting from the transaction. Everything that we do has to be for the benefit of the borrower. Everything that we accomplish in our funding of this loan has to be how the borrower was better off after our loan compared to where they started from. So cash out being used for reserves requires the compensating factor and benefit to borrower It cannot just be where the borrower is just getting a bunch of cash and that's just a benefit to borrower. That, unfortunately, does not meet the requirement.